Money isn't just numbers on a screen, it's the fuel of our world. Decisions about money shape businesses, economies, and even our daily lives. But why do some companies skyrocket while others crash overnight? And how can one bad decision send shockwaves through an entire financial system? Today, we're diving into the power of financial management, how smart decisions create stability, growth, and success, while reckless choices lead to disaster. All right, let's get real. Management isn't just a fancy word for bosses in suits yelling about quarterly reports. It's the art, or in some cases the tragic comedy, of making decisions, organizing resources, and keeping the financial ship from sinking. In economics and finance, good management is what keeps businesses thriving, markets stable, and ideally, economies from spontaneously combusting. Every dollar has a purpose, and how it's allocated can mean the difference between corporate dominance and a spectacular bankruptcy. Think of it like chess, except every piece is made of money and a wrong move can wipe out an entire industry. Just ask the folks from 2008. When management works, businesses create jobs, fuel innovation, and keep economies moving forward. When it doesn't, we get financial crises, stock market meltdowns, and a lot of people suddenly Googling how to survive an economic collapse. But it's not just big corporations or governments making these high-stakes calls. Financial management affects everything from personal budgeting to national economic policy. Whether it's a company deciding between taking on debt or issuing stock, a government balancing a national budget, or you trying to decide if you can afford that third coffee today, spoiler, probably not. Financial management is all about choices, trade-offs, and risk. And speaking of risk, oh boy, that's a whole other beast. Every financial decision is basically a gamble, and how managers handle uncertainty can mean the difference between success and disaster. Some play it safe, focusing on steady returns and long-term growth. Others go full throttle, taking on massive risks in the hopes of hitting it big. Sometimes it pays off, sometimes it ends in bankruptcy court. Risk management is what separates financial geniuses from people explaining their business idea to a bankruptcy judge. And just when you think you've got it all figured out, macroeconomic factors like inflation, interest rates, and market fluctuations come in swinging, forcing managers to constantly adapt. Inflation eats away at purchasing power, rising interest rates make borrowing expensive, and economic downturns can turn today's booming business into tomorrow's cautionary tale. But that's the game. Managing money isn't just about making numbers go up. It's about strategic thinking, balancing risks, and above all, avoiding catastrophic failure. Because in finance, success isn't just about making the right moves. It's also about not making the wrong ones. I'll leave you to discuss in the comments. What's the worst financial decision you've ever seen someone make? Don't forget to subscribe if you haven't already. Take care of yourselves, take care of your loved ones, and I'll catch you soon in another video.